This is the Southside School of Financial Freedom watch list and market report for the week ending November 4th, 2023. Our question this week is: what is the public debt to GDP ratio? The answer will be provided later in the video. This week, the market ended higher. The Dow Jones Industrial Average increased 0.66% on Friday and was up 5.07% for the week. The S&P 500 increased 0.94% on Friday and was up 5.85% for the week. The Nasdaq increased 1.38% on Friday and was up 6.61% for the week. Looking at the week, we can see that there were 15 up finishes for the major indexes, which is a rare occurrence. On Monday, Tuesday, Wednesday, Thursday, and Friday, all the major indexes finished up. New unemployment claims were 217,000. U.S. payrolls increased by 150,000 in October. Labor costs declined in the third quarter. Adjustable rate mortgage demand jumped nearly 10%. The U.S. Treasury Department stated that it planned to increase the size of bond sales in the fourth quarter, and the Fed held interest rates steady. New unemployment claims, U.S. payrolls increasing less than expected, labor costs declining more than expected, adjustable rate mortgage demand suddenly jumping 10%, the U.S. Treasury planning a larger bond sales, and the Fed holding interest rates steady are all news. And news drives the market. Good and bad. Day-to-day predictions on whether the market is going to go up or down are virtually impossible because predicting the news is impossible. However, the market is rigged to go up. It does not go up every day or even every week, but the market will generally go up over time. Stock prices move in a random fashion, they go up and down with an upward drift. Now we are at our question of the week. What is the public debt to GDP ratio? The debt to GDP ratio is an economic measurement of how much debt a nation has when compared to the gross domestic product or GDP, with GDP being the total value of a nation's goods and services in a given year. The ratio is an indication of how well a country can pay its debt. Thus, the higher the ratio, the more difficult it will be for the country to pay its debts. Japan has the highest debt to GDP ratio in the world at about 262%. And number two is Venezuela with a debt to GDP ratio of about 241%. Countries with high debt to GDP ratios may suffer economically as companies and investors may become unwilling to buy their government bonds or invest in their markets. The U.S. debt to GDP ratio is about 129%, which is high. This is high enough to cause bond buyers to not purchase U.S. bonds. Recent U.S. bond offerings have been weak. There weren't as many buyers as there has been in the past. In fact, the U.S. increased bond buying requirements for certain banks. Yes, that's right. Some U.S. banks are required by law to buy U.S. bonds. Corporations also sell bonds, and their credit risks are assessed through their debt ratio. Banks and other lenders determine whether or not a company can pay back their loans based on the company's debt ratio, and that is total debt divided by total assets. A debt ratio above zero point 0.6 or 60% is generally considered to be high. One less than 0.4 or 40% is considered to be low. What is the debt ratio of the companies of your stocks? Or do you own any stocks at all? If not, why not? Is it because you do not understand anything about the stock market? Well, it was not taught to you in school. If you ever want to learn how to get wealth, add income through the stock market, you are going to have to teach yourself. You must RSI, that is, read, save, and invest. Formal school taught you how to read, but society and the powers that be discourages you from reading, especially books. School taught you to be a worker, they did not teach you how to be an investor. And they taught you absolutely nothing about the U.S. financial system. You can learn how to be an investor if you simply start reading books and watching videos about investing. However, books and videos will not tell you which direction the market is going to go, but you can learn how to make money in the market no matter what the market does. I don't know which way the market is going to go on a daily basis, and I don't care. I trade the market as it is, not as it should be. I take what the market gives me, whether it's going up, down, or even sideways. How do I do that? I apply the Southside strategy. You can learn more about the Southside trading strategy at southsideschooloffinancialfreedom.com. Here is the Southside trading watch list from the week ending November 4th, 2023. The strongest performer on the list this week was Editas Medicine Incorporated, ticker symbol EDIT in the third column. It increased 18.21% on Friday and was up 32.75% for the week. Editas Medicine Incorporated is a clinical stage genome editing company. It focuses on developing transformative gene editing medicines to treat a range of serious diseases. Editas has developed a gene editing platform based on clustered regularly interspaced short palindromic repeats, or CRISPR, technology. Looking at a summary of results, you can see that Editas has decreased minus 6.31% year to date. I did not generate cash flow from Editas this week, but I may in the future. Whether a stock goes up or down, you can generate cash flow from it. Whether you own a stock or not, you can still generate cash flow from it using the Southside strategy. The Southside trading strategy involves trading for weekly cash flow, that is, trading for income. SPY is shown at the bottom of the third column. SPY is the S&P 500 ETF. This is the benchmark I compare my trading performance to. My objective is to beat the S&P 500 index while at the same time generating cash flow. Most professional money managers do not consistently outperform the S&P 500 index. They usually lose and lose badly to the index. Thus, most investors and traders should just invest in or trade a market index fund or ETF like SPY. What do you do? Do you beat the S&P 500 index? Do you have a watch list? What is your investing and or trading strategy? How well do you do against the S&P 500 index ETF SPY? Let me know in the comment section. Are you willing to share your strategy? The Southside portfolio cash flow system is outperforming the S&P 500 ETF SPY. The Southside portfolio is up 25.56% versus 13.67% up for SPY, a difference of 11.89%. The Southside is beating SPY by almost 12%. The cash flow generated by the Southside cash flow system for this week was 2.02% of the portfolio account value. The account value changed by 8.58%. Meanwhile, the S&P 500 ETF SPY changed by 5.85%. Bitcoin watch. Bitcoin gained 2.41% this past week and appears to be breaking out into a bull market, though it is down almost minus 50% from its all-time high, which was achieved in November 2021. It is up almost 110% year to date. I sold option contracts on 4 positions this week, 3 calls and 1 put, that range from $3.34 to $55.34. You can get more details, including the total dollar amount of cash flow for the week, on the website southsideschoolofffinancialfreedom.com. To increase your financial IQ and understanding of the stock market, please check out our publication and past videos for other questions of the week. The videos are organized in playlists, levels 1, 2, and 3, and they are also organized in playlists by subject matter. In the meanwhile, please like, share, and subscribe.